Ouch!
Hey, you know or not? Agoda got cheap flights also leh.
Huh? Serious ah?
Yeah lor, my cousin's wife's yoga kaki save a lot, you know.
Book flights with great deals from Singapore to anywhere with Agoda.
All right. Hello, everyone, and welcome back to another episode of my webinar. So let's see. Right. Nice. There's already 52 participants. I'll probably wait for another 5 minutes for more participants to come in. All right. Meantime, I just like to introduce myself, and then before we begin, I'll just introduce myself and just share a little bit of what we would actually do, and then what we have for you guys as when you guys actually I hope that you guys, most of you are already open an account with us. All right. So I'm Joe. I'm from the CFD dealing team. Okay. And what we do is actually, yes, we assist clients who actually open an account with us. We journey them through the whole investment process, and also we give stock ideas and give advice as well. Yeah, to sometimes you would like advice on your portfolio or how you rebalance or adjust your portfolio. You can also speak to us. But of course, main thing is occasionally in times like this, every month we also will have some webinars like this where we share or educate you guys on investment ideas as well as investment methodologies, right? Okay, so here, right, I'd like to share with you, we have a Telegram group, all right? For you, those of you guys who who do not know about this Telegram group, all right, feel free to actually just scan the QR code and join us. We currently have more than 2,001 members in there, and we do share market updates as well as economic calendars, okay, daily, in fact, okay, we talk about the markets daily, US and then Asia as well. So you can see some highlights of the week or the day, okay, with regards to what the markets are doing, right? So yes, I will leave it here for you, those of you guys who just joined, right? Feel free to actually scan the QR code and then join us in this exclusive Telegram group. Okay, we're hoping to actually build a community here, right? A strong community of like-minded investors and traders, in fact. Right. So we take some time for you guys to actually scan the QR code while we wait for some more participants to come in. Okay, so sit back and relax. All right, for those of you who haven't had dinner, you can just bring your dinner, listen to me throughout this webinar session. Great, 65 packs. Nice. Actually, this time I think we have really a little bit more people than the previous one. And I thank you guys. Thank you guys for really joining me. And then I hope you guys really enjoy this webinar itself. All right, which is will be quite an interesting one, because this is more of a masterclass than compared to my previous one. My previous one was more of a talk about. I actually spoke about the US tariffs. Yeah, so it's more like market centric. But this round, I think I would like to share with you guys how I actually conduct my investments. So it's more like a masterclass. So I hope you guys will enjoy it. By the way, every time I start, right, I like to actually look at the markets itself, right? Because the US markets is opening and I'm very interested to see how the markets are actually faring, right? Let's see. Before, I mean, the crowd comes in, I'll just probably give me 2 more minutes, right? So actually, the markets has been up beginning of this week because I think the Fed did not actually raise interest rate. The interest rate is actually maintained. I think it's expected, right? And then, but the only thing here is actually the tariffs, which actually Donald Trump has already implemented, because the tariff freeze has already been lifted. The tariff suspension, the temporary suspension has been lifted. So this is a concern by market watchers. And thankfully, why the market actually has gone up is because I think they're expecting there's a hint that the next there will be a rate cut coming by the end of the year. So this is what analysts are expecting. But of course, thankfully, I think so far this is earnings season, and so far earnings has been quite good. Okay, in terms of most of the big companies in the US, the Fortune 500 companies, right? So most of them actually have been actually doing quite well in terms of their earnings. So currently the futures is quite strong lah. So it's been up. So it's gained actually 0.28% already lah, as of now. But we have to see lah what will happen in tonight's markets, right? But we're quite hopeful that as earnings season continues, I'm hoping that actually most companies will announce good earnings. All right. So without further ado, let's see how many people are there already in here already. Wait. All right. Okay. Thanks guys for actually coming in to join me in this Tuesday evening. All right. So what we're going to talk about today. All right. Today, in my masterclass, I'm going to share with you guys what is value investing. Okay, we're going to talk about the principles of value investing. All right. So before we begin, right, since you already have 75 participants, which thanks so much for the support. All right. A sizable one. All right. So how many of you guys here have heard of value investing? Okay. Have you heard of value investing before? Okay. If you have heard of it before, you can put a Y. Okay. But if you have not, yes, no worries. No need to be shy. Put an N. Because I believe many of you would not have heard of it before. Okay. Wow, many of you have heard of it before. Thanks. Wow, great. Jeannie, thanks so much. Han Yuan, thanks so much. Thanks so much for participating. Chi Kiang, thanks so much. Any more? Wow, actually, many of you have heard of it before. Huh? Great. Oh, at least no. All right. Great. DJ, yes. Oh, Veronica, no. Okay. Right. So, wow. Okay, now the no's are coming in also. Great. That's great to hear, actually. I would like to see more ends, actually. So it will not be so, just me talking and then you guys already know what I'm talking about. But okay, let me share this with you guys, all right? So some of you, right, may think that may have heard of the term, okay, fundamental analysis and long-term investing before. So I believe, you've heard of technical analysis, then there's this thing called fundamental analysis or long-term investing, all right? So if you've heard of this before, okay, do you think as you use fundamental analysis and you have a long-term view of the markets, right? Or you already invested and using long-term, and you invested long-term, do you think it's really value investing? All right, let me share with you. All right, the answer is no. Okay, because many of you are although you have a long-term mindset, okay, and have a fundamental view of any stock that you have, right? You might still have the FOMO mindset. What I mean by FOMO, okay? FOMO means the fear of losing out on. Okay, by buying a good company, actually, there's nothing wrong with it because you've identified a good company, all right? You've screened a good stock, like for example, Google or Microsoft, all right? They'll be doing well many, many years. But imagine buying it at a high price, all right? So if you buy at a high price, of course, then you risk it not performing, okay, underperforming at a certain point of time, and then you might disappoint yourself because you might have been hit with some temporary losses. All right. So what is value investing actually? Okay. Here I'm actually trying to break into the core of it to share with you guys what value investing actually is about. Of course, value investing requires you to do fundamental analysis and also requires you to look at a longer term view. All right. So let me take you through this masterclass, and hopefully you can learn some good basics here, okay, in this lesson. Okay, the concept of value investing has been discovered by this person called Benjamin Graham. Okay, who is Benjamin Graham? Okay, Benjamin Graham is actually the father of value investing. All right, he's the person that started the idea of value investing. Okay, so Benjamin Graham actually noticed that an investment operation is one of which, upon thorough analysis, promises safety of principal and a satisfactory return. Okay, note here, he says satisfactory return, all right? And a promises of principle of safety. Okay, safety of principle, I mean, all right? So he always ensures that his stocks do not lose money. Most important is, the number one rule is do not lose money. Number three, all the three rules also is the same, okay? Do not lose money, do not lose money, and do not lose money. Benjamin Graham always emphasizes this. All right. So any operation that not meeting these requirements, to him is already speculation. All right. So even though you buy a good company, all right, but you do not know what's going on in the company, and you do not know what's going on, the value of the company, you do not know what the value is of a company, you're already speculating already. That's even though you hold a longer term view. All right. So this is what Benjamin Graham thinks. All right. So therefore, Benjamin Graham's concept was to actually identify stocks as part of a business, all right? And to Benjamin Graham, these businesses have a price tied to them, okay? These prices which you see on your trading screens are determined by what the market values of the company. Sometimes, all right, when the market becomes too fearful, they sell, and prices can go below the company's true worth. And when market participants become too optimistic, they buy, and prices can go above the company's true value, all right? So the company's true worth usually fluctuates from time to time, and investors might find it difficult to determine because each market participant has his or her own view of the company's true value. So therefore, right, stock prices, you can see since long time in history, it has been always very volatile. So because why? Everybody has a different view of the market's, the stock's true value. So because you ask why the market is so volatile, like I said, this is because the market is compromised by participants like you and me, all right? And then as participants, we want to outdo each other. So it's actually a zero-sum game, all right? You try to make money from the other person only. So it's actually you like to see who is actually smarter, all right? So we want to outdo each other by guessing who is more correct about the stock, okay, or the company's value. Okay, so we all know, okay, as humans, we tend to follow the crowd. Okay, this has been proven time and time again in history, right? So Benjamin Graham recognizes this, all right? So we tend to follow the crowd and become too optimistic. And when sometimes things tend to become too pessimistic, and we also tend to be very, scared, fearful. So behaviors such as these are what causes the market to be speculative, right? Because when you're fearful, you do not if you do not know what you're doing, you just sell your stock. Then the next day your stock goes up already. Or you're too optimistic, all right? You buy the next day the stock go down already, right? This is always what happens when some of you guys who have actually maybe you are new, you start to buy a stock, suddenly the stock goes down because your friend tell you that or your relative tell you that this stock is very good. So you go and buy already, suddenly the price comes down because you're too optimistic. And then you're too pessimistic. People tell you, hey, sell now, sell now. Then you sell, suddenly the share price go up. Then you say, I regret, I don't want to touch the stock market anymore. Why is this happening? It's because of this, right? Because it's filled with emotions. So Benjamin Graham actually recognizes this, and he says, and he teaches us to focus actually instead of understanding what you actually buy, and then do not focus on the emotions of investments. All right. So that's how you actually master the skill of value investing. This is the core of value investing. It's actually the mindset. Okay. So Benjamin Graham also mentions that smart investor could therefore take advantage of this. Okay. Where he always says that buy when others are fearful and greed. Okay. When everybody is greedy, right? You start selling already. All right. This is how you actually earn decent returns from the market over time. All right. So I believe everybody would have known who this person is. He's actually Warren Buffett. Okay, the world's greatest value investor already to date. All right. He's the most popular one. Although there are many other value investors that are not actually publicized or popularized as like legendary, but actually many value investors, apart from Warren Buffett, does very, very well, and they are also billionaires themselves. Okay. So the popular one is actually Warren Buffett. And Warren Buffett, if you all guys didn't know, okay, he studied under Benjamin Graham. All right. And did very well by value investing. So he understood that the markets are irrational, all right, and often took advantage of rare opportunities to become one of the world's richest men. Okay. So today I will start off by sharing with you what I learned from both Warren Buffett and Benjamin Graham. Okay, so what you will learn today, we shall look at the concept of value investing. All right, so I will share with you first who Benjamin Graham and who Benjamin Graham is and how is he related to Warren Buffett. Okay, and then also next start is I will share with you the fundamental concepts of value investing. So there will be 3 fundamental concepts I'd like to share with you, and lastly, I would like to actually share with you also developing your own value investing framework. So once you learn what Benjamin Graham does and what Warren Buffett does, everyone has their own style. So you have to develop. Once you already know the principal fundamental concepts, you develop your own style because everybody's risk appetite and mentality is different. All right, or your life cycle, your lifestyle may be different. So always form your own frameworks. I will share my framework with you guys. Okay, so sit back and enjoy the webinar. All right. So here's a usual quick disclaimer. All right. The information here is for this webinar is for education purposes only. Okay, it's not a call to buy or sell. Right. So who is Benjamin Graham? This is Benjamin Graham, right? Okay. And how did Warren Buffett, one of the world's richest investors, got to know Benjamin Graham? Okay. Benjamin Graham was a British-born American, okay, financial analyst, economist, accountant, investor, and a professor. Okay. Okay, after graduating from Columbia University at the age of 20, he started his career, okay, at Wall Street, eventually founding this company called Graham Newman Corp, okay, a successful mutual fund that invests only in undervalued companies. And he did very well, all right, in this closed-end fund of his, okay. He taught investing for many years at the Columbia Business School, okay, one of the top business schools in US, where one of his students was Warren Buffett. Okay, so Warren Buffett eventually went to work for Benjamin Graham at the Graham Newman Corp, where he learned from Benjamin Graham the skill set of identifying companies below their true value. Okay, so this skill set eventually led Warren Buffett to make his first million and eventually hundreds of millions by investing in several undervalued companies. Today is worth more than $1 billion. And is one of the world's richest men, all right, just by value investing. Okay, so Warren Buffett's Berkshire Hathaway is a testament that value investing, if practiced diligently, can reap enormous rewards over time. Okay, however, some argue, all right, that it is only during the America's industrialization era, all right, where Warren Buffett actually was during the time just right after the war, the World War, right, World War II, where information was less readily available, and that value investors like Warren Buffett, okay, could exploit these information gaps. Okay, in today's context, of course, because there's the internet, okay, and internet has allowed information to flow much faster, and the market is able to price in any gaps much quicker. So therefore, value investing in today's environment, okay, no longer hold as much weight. Okay, some of you may think this way, right? So is this true? Okay, can value investing really still be applied in today's context readily? Can we still make money using the value investing approach? All right, so this is what we're going to explore today, and what I'm going to share with you the pros and cons of value investing based on my experience investing using the value investing approach. All right, I'll share the downfalls as well. Okay, so firstly, okay, we start the masterclass proper. All right, I'll share with you the three fundamental concepts first. Okay, if you guys haven't heard of Benjamin Graham before, let me share with you what three fundamental concepts he uses to frame true blue value investor. All right, so let's explore these and zoom into them one by one. Okay, the first one, the first concept, all right, is called the passive versus active investing. Okay, so passive means the defensive investor. Active value investing means the enterprising investor. So what's the difference between the both? Okay, so we look at passive investing first, which is the defensive investor. So what is passive investing? All right, passive investing, okay, is a long-term investment strategy, right, that focuses on buying and holding a diversified portfolio of investments, often through index funds or ETFs, index ETFs, all right, with the goal of matching the performance of a specific market or index rather than trying to outperform it. So get the mindset here that defensive investors or passive investors mostly focus on average market returns only. Nothing wrong with that, all right? So essentially, right, it's a buy and hold approach that minimizes trading and aims to capture the overall market returns over time. All right, passive investing is essentially for value investors who generally do not have the time, all right, and have a long-term horizon to their investing of their funds. So let's take a look. Okay, we do a small poll here. Okay, any of you guys here fit this profile as a passive investor first? Okay, let's take a look at this first. All right, any of you guys here are passive? I want to know the profile so that we can at least gauge to see what type of profile that my viewers are here today. So for those of you who think you fit the profile as a passive investor, put Y. If not, just put N. Let me take a look. Wow, Jeffrey, thanks a lot. Thanks a lot, Enchan. Thanks. Thanks, Theo. Thanks, Joyce. Everybody says yes. Anybody say no one? Thanks, Abdul. Wow, so all of you guys are passive. Oh, great. Anthony, wow. Okay, I believe you must have made outsized returns if you're not a passive investor because you tend to study the markets more. Oh, great, David. Oh, nice. Anybody else know? I'd like to see someone knows. Then we can go in. Because I'm a no as well. I'll share with you later why. All right, thanks, BJ. All right, so thanks a lot for the participation, right? So, okay, for those of you who put yes, okay, we start with those who put yes first, okay? I believe, right, that you guys actually fall into the category that you can do more of your time. You can do more of your time and still believe that investing is important in part of your life, right? So let me share this interesting secret with you. Maybe some of you guys already know this secret, but just let me share with you, okay? How you can do more with your time, all right, without the need to monitor your stocks and still invest in for your retirement. Okay, that means you don't need to do anything, all right, yet you can still make market returns without doing anything. All right, sounds too good to be true, right? Okay, let me share this secret with you. This is actually called dollar cost averaging. So I don't know, maybe you guys have heard of it before already, but for some of you who do not, let's give the benefit of doubt, I'll share with you guys what is dollar cost averaging. All right, so dollar cost averaging is actually an investment strategy where you guys have a fixed amount of money, okay, and you invest them at regular intervals, regardless of the asset's price. Okay, so dollar cost averaging, right, involves breaking down your investment into smaller periodic investments, like a monthly period. All right, so you invest a certain amount of money every month, okay, into this particular index, right, to mitigate the risk of buying at the market peak. Okay, this approach, right, helps you to smooth out the impact of the market volatility and potentially lower your average cost per share, okay, over time. This strategy, right, however, only return the average returns of the entire market over time. All right. Therefore, let's say you started to invest in the S&P. Okay. Just give you an example. 5 years ago, all right. You can take a look back at I mean, you can Google this. All right. 5 years ago, by putting in a monthly fixed amount. So every month you put in a fixed amount. Discipline one. Okay. You have to be disciplined in the sense. You cannot like this month you put in 500, next month you put in 1,000. Then this one doesn't work already. All right. So every month you just put in a fixed amount, 500. Okay. And ignore the various ups and downs. Okay. So the market is very high, you just go in. Also, the market is very low. Okay. You just also go in. So you would have averaged a yearly return of 14%. Okay. Annualized. Okay. This is called annualized. Okay. Which is still not too bad. All right. Not too bad. If you're disciplined enough to actually put your funds in the market. Because why is this so? Why you earn 14%? Why you would have made 14% if you invested 5 years ago is because recently the market's actually gone up quite a bit. All right. So you can some investors actually rode on the low and then went up. When the market came back up, they also ride the high and then it averaged out to 14%. Okay. So another one which is called active investing. Okay. So what is active investing? Okay, active investing or enterprising value investor, all right, refers to the hands-on investment approach when investor actively researches and selects investments with the goal of outperforming a specific market index or benchmark. Okay, so this involves, right, the frequent buying and selling of securities. So it's unlike the previous one where you buy and hold just one shot, right? This one involves you buying and selling more times, all right? And then you also delve into several exotic products already, okay? So like you will make use of actually options, okay? And because you make use of options, you already would have done huge research, deep, in-depth research of the stock you are doing research in. You're analyzing it, okay? The investor will usually employ his knowledge of the industry. So you, enterprising investor actually would have already known the business of this company, that this company does very well already at the back of his head, at the back of his fingertips. All right, he would have known the industry. Maybe he has worked there before. Maybe he has worked in the industry before, and he's actually uncovered certain companies that he believes has true value to his investments, to his actually investment knowledge. So therefore, okay, because he can identify the business itself, how the business will grow over time. Okay, he knows the business potential. Therefore, he will invest into such a company. Okay, so what the investor will do is actually this sort of investor will estimate the company's true value and compare the true value with the company's current share price. All right, if the current share price is of the stock is below the true value, okay, of his calculations, the investor will then say that this stock is actually undervalued. Okay, and then the investor will take advantage by buying the stock and profit from the market cap. Okay, if the current share price of the stock is above the true value calculated by the investor, okay, then the stock is said to be overvalued, and the investor should sell the stock and profit from it already. Okay, because he already know the stock is already overpriced. Many stocks are like that nowadays. All right, so that's why you can see Warren Buffett already selling out or taking profit from it. Okay, so therefore you need to identify, okay, from these two. Okay, firstly, you need to, from the first fundamental concept of value investing, right? You need to identify first whether you are firstly passive or active value investor. All right. So you have to see which one suits your lifestyle better. Okay, of course, in active value investing, the more effort you put in to become a better value investor, the more profit you will gain over time. All right, you can even actually beat the market over time. Okay, the second concept Benjamin Graham actually talks about is called margin of safety. Okay, so what is the margin of safety? Okay, the margin of safety is a tenet of investing by which an investor actually purchases securities only if they're trading below their intrinsic value by a certain amount. All right. So for those of you who are still confused of what the intrinsic value is, because I've been talking about intrinsic value, okay, don't worry. I'll delve more into this later in the webinar. Okay, so stay tuned for it. If you want to learn more, about how a value investor actually operates. Okay, so therefore, as long as the market price of the stock is lower than the perceived margin of safety, okay, the lower the risk of suffering a huge loss when an analysis goes wrong. Okay, so you will then ask, by how wide the gap, okay, between the stock's market price and the margin of safety should be. All right. Unfortunately, it's actually quite arbitrary, okay, quite random. The gap will also depend on how the investor actually perceive his risk appetite. Right. So that's why I said for this type of margin, for this concept of margin of safety, the investor has to understand the business, the company very well. Okay, or the stock he is actually looking at. He has to really understand it first before you actually put in money and invest. Then therefore, this is not speculation because you already know, right? You already know that the probability of a loss is low because you already purchased the stock way below its margin of safety, which is like an insurance to you. Okay, so an investor with a lower risk appetite will ensure a wider gap. Okay, while an investor with higher risk appetite and is more optimistic of the company's business prospects will require just a lower gap between the between the intrinsic value of the company and the share price. All right. So the next one is diversification. So what is diversification? So diversification is a risk management strategy that creates a mix of various investments within a portfolio. A diversified portfolio, okay, contains distinct asset types and investment vehicles in an attempt to limit exposure to any single asset class or risk. Okay, this rationale behind the technique is that a portfolio constructed of different kinds of assets will, on average, yield higher, longer term returns and lower the risk of individual holding of a stock. Okay, in diversification, a passive value investor will focus on building a large portfolio of stocks. Okay, this is because the passive or defensive value investor does not have the time to do proper research. So because of that, because he invests in a large basket of stocks, which is usually an index ETF, he at best will enjoy average market returns over time. While an active value investor or the enterprising one will focus on diversification still, right, but at a smaller scale. This is because an active value investor focuses on identifying opportunistic situations that does not come by easily. Okay, therefore, his portfolio at best is less than 30 stocks at any time. Okay, therefore, it's important as a value investor, you should recognize these three fundamental concepts first and develop a framework related to these three concepts to create your own style in identifying good stocks. Okay. So here I also show you my own portfolio, right? To show you an example, okay, of a good, a decent diversification, of how a decent diversification portfolio should look like. Okay, for me, I am currently holding 26% in cash because I've taken profit already from the market. Okay, I'm still monitoring the market because a lot of stocks are now currently already, to me, overpriced. Okay, so equities, I'm currently holding 42%. I used to have more. All right, and I also have some bonds that I have, mostly government bonds and a small size of corporate bonds. Okay, so again, you can see also here that I also invest in different countries. So I don't only expose myself in Singapore or US. All right, I have some in Singapore, some in US, a little bit in Europe, and some in Australia to diversify country risk as well. Because I am aware that sometimes, if something happens to the US, at least I still got Singapore to fall back on. Okay, so guys, do note that you should diversify. Okay, make sure you take note of that. You track your investments as well. Do track your investments. This is very important. Okay, a lot of times I heard from my fellow investors, like my friends, they invest, they don't know what they're investing in, they also don't track. That's very bad, all right. So do take note that you should, when you start investing, when you want to learn about investments, do know what you're buying, number one. Okay, do know what you're investing in, and most important, also do track, okay, and diversify. Okay, so okay, here I'll share with you my own framework, okay, as a value investor. Okay, so my objective is actually to introduce you how an active value investor like myself actually operate in. Okay, so the active value investor approach is also how Warren Buffett actually also operates in. He's also considered an active value investor. Okay, so he has his own framework, I have my own, right? We have different styles. I read a lot of Warren Buffett as well, but I tend to still have my own style of investing. I don't follow everything Warren Buffett. Okay, so I will now share my framework and the tools I use as a value investor to screen value opportunities. Okay, so personally, like I said, I'm more of an active value investor. Okay, therefore I prefer doing my own stock picking rather than just buying the index myself. Okay, I do enjoy the challenge of this of becoming an enterprising value investor. Okay, so to identify opportunities in the stock market, I develop a framework to sieve out such opportunities. Okay, so I begin with this methodology called bottom-up approach as my initial starting point. Okay, when I screen stocks. So what is the bottom-up approach? Okay, the bottom-up approach focuses its analysis on specific characteristics and micro attributes of an individual stock first. Okay, so I begin with actually researching of the company. Okay, but the analysis weigh on the company's fundamentals heavily, but also I look at the sector and the microeconomic factors of the business as well. Okay, so for example, I will identify the company that has built a leadership position in its sector. Okay, this is the first and foremost thing I will do. I will identify the company first. Okay, this company has already a leadership position in the industry it is in. Okay, but the stock also would have been beaten down quite a bit. All right, it's a leader and the stock has been beaten down. I've seen opportunities like that. All right, it's rare to come by, but I've seen it before. Okay, so I will first identify a company that has built a leadership position. Okay, and then I will also begin to study the economics. Okay, and of its business and identify the business model of its whether the business model is a defensive one. Most businesses also go through a business life cycle, and I'll identify the business, which stage the business is in, whether it's in the growth, expansion phase, maturity phase, or declining phase. This is very important. You need to identify first. Once you actually screen that stock, you must see this stock whether it's in the, at least for a value investor, right? An enterprising one, you need to understand the business whether it's in the growth phase or in the already the maturity phase. And when it's in the growth phase, what is it priced at? In maturity first, in the maturity phase, what is it priced at? What is its potential? All right, whether it can continue growing further. What are its expansion plans? What are its, when it's maturity, when it's already in the maturing stage, what are its strategies? All right, and when it's in the declining phase, of course, I try to avoid the declining ones. All right, unless you're very confident that this declining company has a very good plan in place and has actually implemented the plan very well and has shown initial results. If not, I will not touch anything that's declining or in the renewal phase. All right. Okay, after identifying a phase, I decide if the business model of this company actually comprises a mode. So what's a mode? Okay, a defensive mode to me is identified as a company that we can reasonably predict a business performance over the next 10 years. So a good company, okay, usually you can actually easily identify one its business model in the next 10 years. Okay, I would love to give examples. Okay, for one, okay, in current market conditions, all right, one, in current market, in current business environment, right? Okay, one will be Google, for example, which I will share more later. Why I like Google so much, all right? So it has managed to build an ecosystem. So anything that actually can build and has built an ecosystem has a moat already. All right, it's hard to actually break through the ecosystem because there's already a community in there. So that's why the community to move out from this comfortable zone where this community has already used Google so comfortably and it's already part of their lives, it's very hard to actually get out. So that's why the company can actually reap over and over again revenues from this community. So therefore, it's a good mode, all right? Google has a good mode. So I can easily predict already the next 10 years, Google will only improve. So more people will join the community. Therefore, its business will do well the next 10 years. All right, a competitor can still come in, but again, it's going to be difficult. Okay. So this means I must be able to reasonably identify a unique selling point of its business model and how this business model can sustain the business despite, like I said, despite competition, we cannot avoid one. All right, it's natural to have competition. So despite this competition, you must already identify, even if competition comes, when it's the worst case scenario, what's really going to happen. All right. So once I do that, I select a major competitor of his business and make comparisons. So I'll look at a competitor as well and make comparisons to its financials and from its various business segments. So I'll look at its different business segments of both companies, all right, to see if they are aligned or which one is doing better. Okay. So finally, I will compare my target company's stock price, okay, with my calculated true value of the company, all right, which is also the intrinsic value, to see if it's worthwhile to take a position in the stock. Okay, usually at this point, I've already identified my margin of safety. So I will already know what my, after doing my calculations, I already know what my company is worth. All right, I will look at the stock price. Okay, if only there's a huge gap and I identify a huge margin of safety, then only I'll determine how much I will invest into this stock. Okay, so like I said, the general rule of thumb is the wider the margin of safety, the larger my position size, as I know then that my probability of any losses should now be lowered due to my extensive research. All right, so I've done so much research already. I already know the business very well inside out already. All right, the gap is so wide, I can put in a bigger position already because I am confident that the potential or the risk of any losses would be lowered. All right. So the next important thing I would like to share in my value investing framework would be to learn how to read financial statements. All right. Okay. This is also very important as an enterprising value investor. Okay. You need to know what statements mean, what the financial statements mean. All right. You must first understand the three most important financial statements that will usually be published in each company's quarterly, half yearly, and full year financial reports. Okay. So we will look at what is a profit and loss statement, a balance sheet, and the cash flow statement. So firstly, we will look at the profit and loss statement first. Okay, a profit and loss statement is also known as an income statement. Okay, so it is a financial report that summarizes a company's revenues, costs, and expenses over a specific period, ultimately revealing whether the business earned a profit or incurred a loss. So I believe many of you guys would have known what a profit and loss statement is. Okay, so keeping it simple, okay, a profit and loss statement is actually just the company's revenues, when the revenues come in, and then they pay their staff, pay their rental, pay everything out, their expenses, okay, fixed or variable expenses, okay. Then after minusing is tax, what's the net profit? What is the money they earn, all right, from their business that they conducted it, okay. So how about balance sheet? Okay, a balance sheet actually lists the company's assets and liabilities and shareholders' equity for an operating period. Balance sheet provide the basis for computing rates of return for investors, okay, and also evaluating a company's capital structure. In short, a balance sheet is a financial statement that provides a snapshot of what a company owns and owes, as well as the amount invested by shareholders. All right, balance sheet can be used with other important financial statements to conduct fundamental analysis, okay, and calculate financial ratios, which I will share later. What financial ratios I usually will use. Okay, so take it simple. Like a balance sheet is actually just a statement, okay, a report card to show you, okay, what a company actually how is the capital employed? Okay, what the company uses to employ its capital. So the capital can be from you guys as investors, all right, and also money that is borrowed, okay, through the banks or through issuing bonds. So how is this money actually capitalized and invested in several assets? Okay, whether these assets are actually generating good returns for you guys or not, for shareholders as well as debt holders. All right. So this is a report card that shows that this perspective of the company's business. All right. So it's very important to actually understand what is in the balance sheet. Okay, whether the company is actually investing it well or not. All right, whether it is invested in the correct assets or not, okay, or whether it's taken up too much loans to invest in these assets. So sometimes companies take up too much loans to invest in assets, and then that may not be too healthy as well. Okay, so and finally, the cash flow statement. So cash flow statement highlights the company's financial well-being based on its cash inflows and outflows. So inflows are a result of the company's ongoing operations, okay, and external investment sources, while outflows reflect money paid for business activities and investments during a given period. So the cash flow statement actually just shows what a company actually receives in cash and pays out in cash. So whatever it receives in cash and pays out, okay, that balance will show the free cash flow, which is disposable cash right after you've paid out all the suppliers and everything that requires cash. All right. And when you receive the cash, what you do with the cash. So most companies that has good free cash flow are consistently, all right, are good companies to actually take a look at. So if you see a company that has long-term of free cash flow, okay, despite in the growth phase, all right, these are companies that actually you should take a deeper look at it already, because these are good, very, very good companies and very rare to come by. Really very rare to come by, all right? So actually most companies that have huge free cash flows are already usually in the maturity phase, means they are cash cows. Their business, they are not really growing much already, but they are just collecting cash. That's why there's nothing much to invest in. So they just collect a lot of cash. And these companies better be paying out very good dividends, right? Or if they are not paying out good dividends, they should be actually reinvesting them, right? If they're reinvesting them, you may see where they reinvested too. It has to be in businesses that generate good amount of growth. All right. So it's important to understand and link all the three financial statements. And what I do is I will look at these financial statements for the past 5 years at least to get an idea of how the business has actually performed versus its competitors. So I'll look at the competitors past 5 years and also the at least okay, and also the competitors past 5 years financial statements. Okay. I will also additionally look at periods where a major global crisis has occurred and compare its financial statements during such a crisis to see if a company could withstand such a crisis or not. Okay. So a good starting point, for example, would be looking at how a business has performed during the COVID-19 situation. All right. So not only the COVID-19 situation, you can look back at all the major crises and look at how the company has actually done for investors. Okay, has it been growing in terms of, like I said, has it been generating free cash flows? Even though during the financial crisis, it's still been generating free cash flows, as an example. All right. It's taken low debt, okay, despite during financial crises. Okay. And yes, and the P&L is still growing. Despite a financial crisis, it's still actually making good money on the balance on the profit and loss statements, and then also on the cash flow. All right, it's still generating good cash flows despite in a major crisis. Then you will know the next crisis that happens is very likely these sort of companies can withstand. All right. So the final framework I would like to share with you tonight will be to understand and use some of the financial ratios to screen stocks. All right. So this one is actually what we will be looking at is financial ratios as my final framework that I use, right, to at least the initial stage of actually screening a good value stock that I will look into deeper. Okay, so basically there are a few ratios Benjamin Graham would use, to screen the relative financial health of a company. Broadly speaking, these ratios could be used to measure liquidity, solvency, profitability, and efficiency of a business. Okay, so these ratios could give the investor a relative comparison and allow the investor to decide whether a company is worth his or her investment. So in liquidity ratios, we are assessing the short-term financial health, of a company. And for solvency ratios, we will use that to evaluate the long-term financial stability of a company. And for profitability ratios, we measure the financial performance of a company relatively. Okay. Efficiency ratios, we look at the operational efficiency of a company. Also by looking at it, because all these are ratios, we look at it relatively. Okay. And market ratios, this is how we perceive market valuation and intrinsic value of the business. Okay. So the first ratio I would like to share will be the PE ratio. Many of you would have heard of this before. Okay, so what is a PE ratio? Okay, stock valuation, this PE ratio is actually the price earning ratio, which measures the company's share price relative to its earnings per share, often called the price earnings multiple. Okay, the PE ratio helps to assess the relative value of a company's stock and is handy for comparing a company's valuation against its historical performance against other firms within its industry or the overall market. So how will we use the PE ratio to identify if a target company I like is selling relatively cheaper than before? Okay, this is the initial screening stage. Let's look at Google. A good method, we will be looking at Google's PE ratio. Okay, its average PE ratio for the past 5 years, which is actually 27 times, all right? And I compare it with the current PE ratio of Google, which is now sitting at 20, okay? So this says that in a general way, all right, Google is actually trading cheaper than its 5-year historical PE average. Therefore, a good analyst will dive deeper, okay, into the stock to identify the reasons why Google is actually currently selling below its average PE, okay? The next ratio I will use is the price to sales ratio. So what is the price to sales ratio? The price to sales ratio is a financial metric used to evaluate a company's stock price relative to its revenue. Okay, it indicates how much investors are willing to pay for each dollar of a company's sales. A lower price to sales ratio may suggest that the stock is undervalued, while a higher ratio might indicate it is overvalued. But this can vary significantly by industry. Okay. Again, we use Google as an example to identify Google's average 5-year price to sales ratio, which is about 6.5 times. Okay, this is a 5 years average PE ratio, average price to sales ratio, 6.5 times. Okay, and compare it with Google's current price to sales ratio, which is 6.7. So the metric indicate that Google's share price has been trading at least 6 times above its revenues in the last 5 years, and this has not changed much. Okay, the final metric I will use would be the price to free cash flow per share ratio. As I said earlier, free cash flow is very important, all right, for a value investor to identify whether the company is actually healthy or not. Okay, so what is the price to free cash flow per share ratio? The price to free cash flow per share ratio is a financial metric that compares a company's market price per share to its free cash flow per share. It helps investors assess how much they are paying for each dollar of free cash flow a company generates. A lower price to free cash flow ratio may suggest that a company is undervalued, while higher ratio may indicate it's overvalued. Okay. Likewise, we use Google again as an example. Google's past 5 years price to free cash flow was 36 times. All right. So the past 5 years is 36 times. Now, what is his current one? His current free cash flow is actually price to free cash flow ratio is 34 times, which is already lower. So indicating that Google share price has been trading lower than its average recently. So therefore, a good analyst, again, would therefore dive deeper into Google's cash flow statements to identify the reasons for the decline in this ratio. It's a good thing because it shows that it could be undervalued, but why? Okay, there may be reasons behind it which warrants your investigation. Okay, so as a summary, the 3 financial ratios that I shared above will be used to do an initial screening of my target stock. Okay, I tend to hold very strict guidelines, okay, and require all 3 ratios to be significantly lower than its 5-year averages before I tend to dive deeper into the financial statements to look at what is going to happen. I mean, what is actually behind all this, behind its lower than average ratios, okay? So because of these strict guidelines, I tend to have a higher margin of safety, okay? And my window of opportunity to buy good stocks become much, much smaller. Okay, this means that I only tend to shortlist a target stock when the share price has declined significantly, okay? And it has to be a very good company and which has very good track records. So it's very, very rare to come by. Okay. So how has value investing done for me so far, you might ask? So I'll show you my total returns as of 26 July 2025. I started this fund, in fact, in 2023. Okay. So this is just an example. My portfolio actually generated 110% in total returns. Okay. And this is versus the returns of 34% on the S&P 500. So can I say the value investing still works today? Okay, again, I would say it depends, right? There's something called the value trap, okay? Some investors will actually fall into a value trap. So a value trap, okay, is when, okay, you as a value investor believe that stock is truly undervalued and this stock has indeed great potential with great earnings prospects, but could sit undervalued for many, many years with no share price growth. All right. A good example of a value trap stock would be Alibaba, okay, where there were many investors that saw an opportunity in Alibaba selling below its true value, okay, for many years. And today, okay, the stock has still not yet produced good returns, all right, in its share price. Okay, so if you held Alibaba for the last 5 years, believing that it is still undervalued, you'll be down already 50% today. Okay, So active value investing will also not be able to work well for everyone. Okay, as everyone's mindset and risk appetite could be very, very different. Okay, to generate good returns, you need to put money, you need to put effort in your research. And when the opportunity comes, you need to agree with your data and go with your gut feeling by investing a sizable sum. Okay, based on my years of investing experience, right? I think that no matter how good your research is, there's still a probability that you could get it wrong. Okay, for example, you could have invested into a value trap stock. Okay, therefore, I believe that there's some element of luck as well. All right, apart from good research. So when things go wrong, what do you do then? Okay, you have to acknowledge it and cut the error short. Okay, don't wait until it's 50% down, then you start to say, okay, I'm wrong. Once you're wrong, you must have actually a buffer that you should cut your investment. Okay, the idea here is to get it right most of the time. Okay, so most of the time you invest in value stocks, you get it right most of the time. Only sometimes when you get it wrong, make these losses small. Okay, I hope you have picked up something in today's webinar. Okay, and if you are really keen in if you do have a keen interest in investing and would like to learn more, okay, more than this what I've taught you in terms of basics, all right, you can pick up this book called The Intelligent Investor by Benjamin Graham. I highly recommend it, and because Warren Buffett actually has read this before and it's actually guided him. It's like a Bible to him in terms of his value investor methodology, and it's been a Bible to me as well. Okay, throughout my investing journey. So I recommend it to everyone who has zero knowledge in finance, because this book is written for the common man on the street who wants to understand what value investing is truly about. All right. So here I would like to thank you. All right. And okay, before we get into the Q&A section, I'd just like to share with you again. Okay, we have a Telegram channel, and you can just post your trading ideas here. We will usually post our trading ideas here. I'm sorry, you also can post your thoughts as well when we post our trading ideas. Okay, you can share your thoughts as well through the chat. So we are trying to build a community here, all right, strong community that shares ideas, because we are all learning at the end of the day. Okay, no one's better than the next person. All right, the investing journey is long. Okay, I highly encourage that you guys just join this and then share your thoughts, so we can learn from each other, and then we'll get better over time. So, right, okay, we can start with the Q&A session. If you guys have any questions to ask, feel free to ask questions, right? Or if you guys have anything to share about value investing, your thoughts on value investing, all right? Because I understand that many people actually have other school of thoughts and think that, okay, maybe sometimes technical analysis is better. Then you can share the reasons why as well. Then we can argue the thoughts. Oh, what do I think about USA Quantum? Okay, Patrick, can you share with me? I haven't heard of USA Quantum. Maybe it's a good stock that you identified as a value stock. Can you share with me what this company actually does? Then I'll take a look at it now to see what this company does. USA Quantum. Any more questions? Right, nice one. Durian Laksa. Okay. How do you decide which industry and stock to shortlist? All right, for me, okay, what I will usually do is, of course, this is a very good question. All right. For me, okay, personally, right, I will only look at stocks that I'm familiar with. I will only look at industries I'm familiar with. So I will start off with actually looking at, for example, I go on the street, right? I see many people nowadays using Apple phones. And more actually youngsters are using Apple products. So I start to question, why are people actually, what's so good about Apple that actually allows people to actually enjoy using Apple products so much? Okay, so I will probably hop into an Apple store, take a look at, I compare it with other mobile phone shops like Xiaomi, Oppo, Samsung. No one, usually when you walk past shopping malls, you don't see anybody in these stores. Not many people looking at the phones. But when you go to Apple store, always is crowded. There's an experience there, something that you cannot get. So I'll try to, okay, of course, I'll buy Apple products as well. I use it. From there, I don't turn back. I like it so much already. Then I will look at the company already. What is Apple actually, the business Apple is dealing in, okay, is industry. Okay, for example, Apple's in the hardware industry. So I'll look at the hardware industry. And from this IoT industry, like the Apple, like handphones, okay, I will start delving into other competitors that does mobile phones as well, like maybe Xiaomi or could be Samsung, all right, and see in terms of financials, in terms of their business strategy, what is Apple doing right that other competitors are not doing. So this is what I will look first. What I will look at first. I'll look at the man on the street first. All right. And then when I look at the man on the street, what they are doing, okay, it seems that there's something going on there. Then I'll start looking at the company and I said maybe I should invest in a stock like this. All right. Another example I can give you as well is Sephora. Sephora sells cosmetics. All right. They are the new disruptive new model of actually last time when you go to departmental stores, like when last time when you want to buy cosmetics, you go to departmental stores like Isetan or Takashimaya, they will always be in the first floor. But nowadays, Sephora has taken over this business model where it has something going on that young people like to go into Sephora to buy their cosmetics instead of going to Takashimaya or Isetan to look at cosmetics, or could be other competitors. Why? So I tend to look at this and identify, as a man on the street, why are people actually have interest in such a product or such a brand? Then I'll go further. Who owns Sephora? Actually, LVMH owns Sephora. And then I'll compare. Is Sephora actually doing very well in terms of their business model inside the LVMH brand, umbrella of brands? So if yes, then I'll start to look at LV to see how is it doing in terms of its financials, and then compare the industry. Something like this. All right, Patrick, okay, let me see. Okay, sorry, I'll try to answer everybody. Okay, what's my view about this industry, quantum computing? Oh, okay, quantum computing, I would not be too sure. Okay, because I'm not an expert in this field. Okay, so sorry to destroy your thought, but it's a good question. All right. But what, okay, instead I would say, what do I think, okay, about the AI, or would I say tech, because tech is very wide. Okay, tech is too wide. Okay, if I would say AI, okay, let's look at AI. AI is okay. AI could also implement quantum computing as well. All right. So if I look at AI, okay, I believe AI is very promising. All right. That's why I invested in Google, because I believe that Google is the AI could be the new age of Internet 2.0. So Internet 2.0, you just use a browser. Okay, for example, for your information, guys, I've owned Vision Pro before. Okay, I've owned a Vision Pro. Okay, so Vision Pro is actually created by Apple. Okay, it's one of Apple's products. So this is actually a VR goggle, augmented reality goggle. Okay, so this goggle actually can enhance your entertainment value, okay, because you see things in augmented reality. So when I look at this, right, when I use when I use Apple's Vision Pro, I realized already how big actually AI can improve our lives in the future. So in the future, you would not be using computer screens anymore, or the phone screens anymore. I believe that the future would be using your vision to actually browse the internet. Okay, the internet 3.0, right, would be augmented reality, right? So when you have strong beliefs in this, all right, you try to find a winner. All right, I know it's hard to actually identify winners. All right, for example, how would you know that Apple will be a winner next 10 years? Nobody will know that, but you need to be reasonably certain in the next 10 years, okay, based on its community growth, because you can see on Apple how many users, how much the growth of its users every year. Okay, you see active users growing every year, then you know already, okay, Apple is building something, they are into something. All right, these are the things that you should take a look at. If there's a growing community and you are reasonably sure that their technology is actually improving towards building a fundamental vision for the future of Internet 3.0, that is the thing that you should go into, right? So I think quantum computing is probably something that is going towards AI. If that's the case, then I believe that we can probably take a look at this industry. Yeah, because I believe in the AI. It's not a buzzword lah. Some people will say it's a buzzword, but I believe in the how AI would change our lives drastically in the future. Yeah. All right. So let's see. Next one. Okay, Nev. Okay, why are there no exposure to China in my portfolio? Okay, what I do not like is okay, like I said, as a value investor, I could be wrong. Okay, you guys maybe maybe better than me in terms of value investing. You guys maybe see something that I don't see. All right. I may not be able to see everything. All right. Like Warren Buffett said, he's not good in everything. All right. Some of us are only good in playing badminton. We cannot be also good in playing golf. Right. So for me, ultimately, I do not like the Chinese government's policies because it is too okay, I don't want to talk about politics here. I mean, I try to be diplomatic here, right? But I feel the Chinese policies are a bit too uncertain. So that is why, like you see, Alibaba's value has been destroyed by such. Alibaba is a good company, all right. It is undervalued. I've studied the company's financials before. It has a good, strong fundamental business model. Okay. Although, okay, I would say the only weakness in Alibaba is why I did not invest in them is because they are only good in one area, which is e-commerce. Other areas and cloud, okay, cloud is growing, okay, but still, most of its business models are actually making losses one. So when I see things like making losses in other segments of the business, I will not invest already. No matter how strong their cash flow model is, I will not invest already. I will not touch. All right. So again, another part is the Chinese policies are too, I would say, volatile. Sometimes it can change, and then it will destroy the shareholders' value. That's why I try not to stay. I try to stay in things like I'm more certain in. Right. Like I know Singapore very well, so I tend to invest in Singapore companies because I know the Singapore's government policies very well. US, you will know, they are quite transparent because US reports its earnings every quarter and it shows you in the 10Qs every quarter. So it's very transparent. You can really track through how companies are doing, how the businesses are doing each quarter, right? So that's why I said America is still very good in terms of actually transparency. That's why it's harder to get good value in America. Sometimes you can get good value in China because, like I said, it's harder to actually get into the system. It's less transparent. That's why if you dare to invest, sometimes you may reap very, very huge profits from countries that are less transparent. So that's why I said value investing. Sometimes if you're there, if you're good, all right, in it, and you have the guts to go in based on your gut feeling, yeah, then you will reap strong returns. All right, that's a good question. All right, thanks, Neff, for this. Okay, Sally, okay, she said that there's conflict between value investing and short-term profit taking from the same value stock. How do you decide when to take profit from the chosen value investing stock? Okay, so how I'll put it in this, okay, is that for me, all right, again, everybody could be different. I would like to share only my own point of view, okay, my own opinion. Value stocks for me will be long term. All right. I usually when I buy a stock, I tend to sit on it more than 5 years. Right? All right. And so far when I sit on it, it hasn't made me any huge losses before. Okay. In fact, I never actually get any losses before because I tend to buy it very, very cheap. That's why I tend to enjoy, even though when the market comes down, I'll still see in fact, when the market comes down, I buy more money. Right. But because my average is actually on the low side. So I tend to see when markets come back up like now, all right, I tend to see very outsized returns. Okay, so should I take profit? Okay, like you said, in the short term, all right, when you see already a profit, should you take? Okay, the answer is yes and no. All right, it depends on how you actually perceive the value of the company. Okay, if you are talking about value investing, we are not talking about charting here. Okay, charting is a totally different thing, right? We're talking about value investing here. If you actually see that the stock maybe make 5% already or 10% in the next few months, should you sell? All right. Why has the stock gone up 5-10%? Maybe you could have been right already. You bought the stock at a really low price at that point of time. It's really a true value stock. That's why investors realized it maybe after you. So they bought up the stock and then it went up by 5-10%. Should you sell? All right. Again, okay, you should take a look at what the financials are actually telling you. Your data is actually telling you. If in the next, you see that next few years, all right, okay, you look at the data and then you look at, because most of the time you invest in US companies, they will tell you the company's outlook. The CEO will usually share his outlook for the year itself. And if you look at what the CEO shares, and the CEO has a good prospect of the industry, of his industry and his business, then you shouldn't sell, even though it's up 5-10%, because what for you take a profit, a short-term profit of 5-10% when this thing can grow about more than 100%. Warren Buffett has sat on his stocks for many, many years and it's grown 3,000 to 4,000%, right? So many folds. Why? Because of the concept of compounding. Because a company also can compound its earnings, right? A company today, even though, okay, let's talk about Apple 30 years ago, right? It may not be popular then, right? So if you can see the future, okay, if you know already reasonably, you can see that Apple could grow into a sizable company, or Microsoft could grow into a sizable company. This sort of compounding could reap you, multiple fold. So why sell in the short term rather than hold in the long term? But yes, if let's say you look at stocks that are already overvalued, all right, you see that there's already no more potential already for the company to continue growing. For example, Apple, as of now, all right, its stock is, I mean, it's iPhones have already been in the declining stage because of China. Okay, it's already closed some Apple stores in China. Then yes, you look at its multiples now. I mean, its earnings versus its share price now is really way too far, and it's been like that for many quarters already. So that's why Warren Buffett took profit, right? Because he feels that the only way for the share price is to come down, right? There's no longer, it cannot continue going up, because when it goes up more, investors are expecting higher returns. I mean, higher growth in its revenue, which is not possible already. You already can see in the near 1-2 years. So that's why Warren Buffett took profit. Okay. So thanks a lot, Sally, for the question. Good question. Okay, David, Tesla stock has a P ratio of 300, and yet investors are still seeing the future rise of stock. How do you use value proposition to decipher this stock? Good question. I like to talk about Tesla actually. Right. You see, it's a very good thing that you already you can see if Tesla has a PE ratio of 300, we used to go in, right? For me, that's why I don't own Tesla, right? To be upfront, I don't own any electric vehicle stocks, because first thing, what I see in electric vehicles is there's some hype there, all right? There are many competitors coming in to build an electric vehicle, all right? To build this brand to build a community or belonging or ecosystem in the EV business, so far I have not seen any winners yet. That's why it's very hard for me to actually decipher value in EV, in the electric vehicle industry. Okay, what's the difference between Tesla and BYD? I believe now BYD is actually getting more and more popular based on what I identify with speaking to my friends, people who actually who are car enthusiasts. All right, they now prefer buying a BYD instead. All right. Again, BYD may not be. What's the difference? I know BYD compared to another electric vehicle car that is out in the market. There's no difference. I mean, for me, at least there's no difference, because I can drive a Tesla, I can drive a BYD. It still looks as good. So it's unlike using an Apple phone or an iPhone versus using Android. A lot of people tell me there's huge differences, and you want to go back to it. Once you use an iPhone, you want to go back to using Android. If you use a Tesla, anytime, if let's say BYD has a better car, you will straight away shift to BYD. So competition is stiff. Okay, there's no huge defensive mode there. I will not, based on the PE of 300 times 300 PE, I will not buy. All right. But why are investors still seeing value? Is because they believe that Tesla is actually building. Of course, number one, there's the Elon Musk factor there. Okay. The next one is actually Elon Musk has sold the idea that there will be robo taxis and stuff like that. So if the robo taxis happen, everybody in the world, all the taxis in the world will be using robo taxis, okay, driverless taxis, and that could change the valuation of Tesla drastically. Okay, if that happens. But again, have I seen that? No. So that's why 300 times, no for me, right? Thanks for the question. Good question, David. Thanks a lot. Thanks a lot for the sharing. Okay, Charlene. So what do you mean by intrinsic value? What value you are looking at? PE, P&L, PE, dividend yield. All right. So intrinsic value comes in a different form. All right. So yes, okay, PE is one of them. So the relative values of a stock will determine also the intrinsic value. I did not share this today, okay, with you guys, because today my sharing is at best a basic masterclass, right? To let you know what is value investing all about, okay, the framework of it. All right. So another way I use to determine the intrinsic value, apart from all these PE, all these ratios, all right, is the discounted cash flow model. All right. This is a very interesting model that even Warren Buffett uses. All right. So it discounts the cash flow or the earnings of a company throughout the many years. All right. So this model estimates the earnings of a company in the next 10 years, for example, next 5 to 10 years. All right. And it discounts it back to what is it today. So it's similar to if you have studied finance before, or if you have understood financial modeling, where a value of a dollar today, okay, is not the same as the value of the dollar in the future, right? Because of inflation. So we tend to bring the dollar of the future back to today and see how much it's worth. So for example, rental you can use this, you can use it to calculate the value of your property based on, you know, what's the rental doing today, because you already know your rental can be covered for the next 10 years. If you're a landlord, you bring you discount your rental to today, right? That's the value of what your property should be worth. So we use this concept to identify the intrinsic value, all right, which I did not share. So a good way will be to actually pick up the book, The Intelligent Investor. It will share a little bit more about how to use actually the discounted cash flow model, all right? But this discounted cash flow model, because it's quite arbitrary in terms of what is the discount rate you should use, okay? It's all based on what I see based on the PE. So this one comes with experience. So you need to understand the relative PE ratios, all the ratios that I've shared, all in a whole picture. Okay, once I identify the whole picture, the whole spectrum of the ratios that I get, okay, and then use this to come up with a discounted discount rate, which is my risk, my expected return rate. Okay, it could be a little bit complex now, but as I said, okay, to pick up the Intelligent Investor book. So this discounted rate is actually the rate of return that I expect my stock to give me in the next 10 years. So if I expect, because of my risk, okay, I expect the stock to give me 20% returns for the next 20 years. So I discount that backwards, and that will give me the true value of the stock, okay, based on my estimates of the company's financials. How do I get the estimates of the company's financials? Okay, based on the outlook given by the CEO, the P, all the ratios that I use, okay, and my framework earlier on that I shared. Okay, I use this framework to screen through and identify at best my estimates to use. Okay, I will not use an overly optimistic estimate. I'll use a pessimistic estimate. All right, I have a best case scenario and a worst case scenario sort of estimate. Okay, it will not be overly optimistic type, and then I use it to calculate the intrinsic value. And the share price has to go below that before I start investing in it. So my guidelines are quite strict. All right. So anyway, thanks Charlene for this. Okay, repeat again the 3 ratios I use. Okay, the first one, okay, I use is actually the PE ratio, the price to sales ratio, okay, PE, PS, price to sales, and the other one is the price to free cash flow, okay? Okay, Jeffrey, what do you think of these 2 companies, Longi Solar, wow, and SMIC Conductor? Do you have exposure in China? No, I don't have exposure in the Chinese portfolio. Yeah, like I said, because I'm not very good in actually identifying Chinese stocks lah, right? So because of the policies there, so I'm not very good. But unfortunately, yeah, I'm unable to actually identify these 2 companies at this moment, Longi Solar and SMIC Semiconductor. But I believe the semiconductor industry is quite competitive though. Yeah, so I like, you need to get a very good company, which has very strong business model. If not, like, you know, if you invested in Intel, for example, it's not doing well. Yeah, it's quite a dying trade. And there's so many semiconductor companies going around, you know. That's very hard for me to actually look at one, you know, that I like. Yeah. So sorry about that. So Jeannie, thanks a lot. Undervalued stocks can sometimes be illiquid and under radar that many people may not realize it. It may take years for the value to unlock. Would you consider the trading? Let me see. Would you consider trading volume of the stocks? Is this kind of stock still worth investing in? Okay, yes and no. All right. That's why Warren Buffett actually moved away from investing in, these are called cigar butt stocks. All right. What you're looking at, okay, Jeannie, undervalued stocks that are illiquid is actually considered cigar butt stocks. All right. This type of stocks can make you money. All right. But it's very risky. So Warren Buffett moved away from this and invest instead in high quality, good companies that are trading cheap. Okay, which is quite hard to come by. But now he's changed his model. This can be an investor who really specializes you must really specialize in the stock itself. All right, you must really understand the business, because at the end of the day, you have no major control. Because investors who conduct in this sort of investments which stocks are illiquid, they tend to buy a controlling stake. So only unless you can buy a controlling stake in such a company, I suggest you stay away, because eventually the company can buy you out very easily because you are a minority. But you can be sometimes very lucky, and then you can reap very good profits, because there are people who actually buy such stocks. Eventually, they got bought out by a big investor, because, like you said, you've seen the value. It cannot happen for many years. No investor actually buy it out, but eventually someone does, because that big player sees that value in it and eventually buy it out, and you reap huge returns from it. These are usually penny stocks. Okay. Okay, durian laksa. As companies have vested interest not to disclose bad outlook, how should we discern if CEOs are overly optimistic? Yes, you can discern that. So you can, based on the previous results of the CEO, when the CEO actually tells you this sort of optimistic ideas and plans, and then you look at the next quarter, did he really roll it out? If you still continue talking about the same thing over and over again, and then the financial earnings tell you, the financial statements tell you differently, then you already know a red flag. Okay. So SY, PE and PS. Okay, type here, yeah. PE, PS, and I just type it for you again. SY Pang. Okay. And price to free cash flow. Free cash flow. All right, I type it for you guys already. Okay. Yes. Can you let us know, Charlene, again? Can you let us know what are the values required for the 3 ratio? PE, PS, price to free cash flow. Okay. Good question, Charlene. Okay. The 3 PE ratio, the 3 ratios, I would say the values. Okay. This is quite arbitrary. All right. Only for the experienced investor, you will know what ratios to use. So this is actually over time you will learn. Okay. It cannot be a one size fits all. All right. For all these 3 ratios, it cannot be a one size fits all, because every industry operates differently, and every industry have P ratios, because you must take a look at, okay, instead of the many years they're operating in, maybe for the past 10 years, what has the ratio been like? All right, if the ratio has been sitting around 30 times for the past 30 years, for the past, okay, not 30 years, for the past 5 to 10 years, then reasonably the ratio should be around 30. If you see it come below 30, there should be a signal that already flag you out, that you should take a look. Why it suddenly, so many years is 30 times, then suddenly this year is like lower than 30. You should go and investigate. All right. Same likewise for the price to sales. All right. If you see many years already, the price to sales has been sitting at 6 times, for example. Suddenly you see the price to sales ratio lower than the 6 times this year. Oh, why? Is it because suddenly the stock is not doing well, or suddenly there's a lawsuit or what? We never know. Okay. So if you see reasonably well, despite actually when I look at every year it's already sitting at 30 times PE ratio. This year is lower because of a temporary maybe some bad news about the company, maybe a small lawsuit that occurred that caused the company to sellers to actually sell because they are scared. That's a good time to buy. It already will ring a signal to you that, okay, you should look into this stock deeper. Okay, but there's no one size fits all. Okay, even though the intelligent investor does share some values to it, they assign some values to it. Maybe they will say, okay, below 10 times PE. But again, it doesn't apply, because when I took a look at it, below 10 times PE, last time when I bought stocks that are below 10 times PE, it did very badly for me because, again, these are really lousy companies. That's why I'm selling it very cheap. So sometimes companies sell cheap for a reason. Okay, so be careful, right? These are also value traps. Companies sell cheap for a reason, all right? There's no reason why companies can be selling so cheap, one. Okay, already investors already discounted. Unless you see something that's selling cheap, all right, then you see things that other investors don't see, but this is very rare because you are not an insider. All right, so I prefer to buy stocks that are selling cheap, all right, but are good companies like Google, for example, Apple, for example, Facebook, for example. They are very big companies, but they are selling cheap. Then I'll buy them. Okay, Richard. Okay, with value investing, will you typically still invest in the stock when it's run up 10 to 15 times? When you believe it has more upside, or you wait for a pullback first? Okay, let me read it again. Will you typically still invest in the stock when it's run up 10 to 15%? When you believe there's more upside? Of course, yes, I will. Because again, I said, it really depends on how you perceive the value of the business. If you really see that this business has huge potential, and you already see that the earnings, I mean the financial statements is really strong and solid. I think 10 to 15% up, still nothing, because if you've identified that this company can still grow way stronger in the future, okay, in terms of generating free cash flow, like I said, okay, very important thing, all right, make sure you do not go into the hype, okay, that's why a PE ratio is very important. If the PE ratio, like I said, is 300%, 300 times already, okay, then the stock goes up another 10 to 50%, of course not lah, because you already not confident that this company can continue to grow another 300 times, right? 600 times PE, not possible. I know the company should grow another, 30% in terms of its revenue growth year on year for the next 10 to 30 years, not realistic already. All right, because there's a business cycle. When there's a business cycle, no business can continue going on a straight line up. Okay, so make sure you take a look at the relative values as well. You don't only look at iFast. iFast is a good company, actually, I would say. It is a platform provider, right? But I haven't actually really looked at its financials, all right? But most important, I think, Richard, take a look at the relative values first, okay? Look at its ratios, all right? As long as it's selling still reasonably, for the past 10 years, it's still selling, the P ratio is still selling around, maybe, I don't know how much, okay, maybe 15 times. If it's still holding upon 15 times and it's not gone up or gone down, then you can probably take a look at it. Oh, okay. Behind my exit strategies, what do you think of United Health? The share price has been dropping, but insider buying of stock, do you make it a value stock? My exit strategies. Okay, my exit strategies would be, okay, like now, okay, for example, I'll take a look at Apple. All right, I see that Apple has already been the business segments have already been stagnated. Okay, so when I look at their earnings performance, okay, in terms of month-on-month and year-on-year growth, it has already been stagnated, and some of them have already declined. All right, quarter-on-quarter, year-on-year. So I look at quarter-on-quarter, year-on-year, month-on-month, everything I look. Okay, so I'll compare all relative based on relativity. Okay, and I see that it's been coming down. All right, and then the PE ratio is still hitting higher and higher. It's still staying at 36 times when the average could be lower than that. Then it's really a signal for me to actually sell down the stock. And I've done it, I've already been doing this. That's why I'm sitting on more cash now. Okay, so you can also look at exit strategy this way, okay, by identifying whether the company is actually way above your average PE ratio that sits comfortably with you. That means what I mean to say is that if the PE ratio of this company on average is 20 over times, okay, today it's sitting at 36 times. Already, it's a good time for you. It's already on average already 20 times, okay, for the last 5 years, and then today it's already 36 times. And then when you look at its financials, when you go back to its books, you look at its books, the growth is not very strong. Why would the market price it at 36 times? Right? The market is way too optimistic. So they may be pricing in something that they cannot get elsewhere, okay, in terms of their investment. So you sell it to them, because at the end of the day, you know that when the share price comes down, you can buy it again. Okay. United Health, I'm not very sure about United Health coming down. There's insider buying this stock. So do I make this a value stock? Okay, insider investing. Okay, I would say also some people actually take a look at also institutional buying. Okay, whales buying. Okay, up stock. So they track that volume as well. Okay, for some value investors, they do that as well. So like I said, everyone has different styles of looking at how to value a stock. All right, so some people look at it this way, but they look at whether big insiders are actually coming in. So this could be one indicator as well. But again, sorry, I'm not very sure of what I think of United Health. All right, because I didn't really look into this stock. But thanks, Durian Laksa. Yeah, thanks for bringing out this point. Yes. All right. Anyway, it's past the time already. Thanks so much, guys. It's already 9 o'clock. Thanks so much, guys, for the many questions coming in. Thanks for the participation. It is really, really good participating. Yeah, and great community today. Wow, 62 participants. And then thanks so much. Yes, thanks so much for actually supporting this webinar. And I hope to see you guys again. All right. All right. Have a good night. Thank you, Charlene. Thanks so much. Thanks, Veronica. Thank you so much. I'm humbled. Thanks so much. Thanks, Lau. Thanks. Thank you. Thanks, Tan. All right. We catch up again. You can actually, you have my email here. Anything, just let me know. All right, can email us. All right, goodbye. Bye.